afternoon, everybody, and welcome to today's webcast where I'm joined by the legendary fund manager, Mark Yusko. Mark needs little introduction, but to reiterate, he is the founder, CEO, and CIO of Morgan Creek Capital Management. Mark has this wonderful contrary investing streak that's taken him into the upper echelons of global institutional investors. He's blessed us with his presence before. I believe the last time was back in February 2023. I have the strong sense that he'll be plugging into his top conviction, which is the crypto space. And while I've been a long-time skeptic, I have to acknowledge that his call has been rather prescient. Bitcoin has more than doubled since the last time Mark joined us. So let's keep an open mind. Hear what he has to say. He is a money maker after all. And Mark is going to hit off with his worldview of all things related to financial markets. Then we'll turn it over to Q&A and the usual fireside chat. Please don't forget to ask questions as we go using the Q&A tab at the bottom of your screen. So with all that, Mark, thanks a ton for coming on the call today. Over to you, and please take as long as you want.
No, thanks, Dave, and really appreciate you having me back on the show, and appreciate the kind introduction. It's always fun to get together. You and I are kindred spirits of a sort, in the sense that I think we pride ourselves on being independent thinkers. And that doesn't mean we're right all the time or wrong all the time. It just means that we try to think a little bit differently. And, if they say, one of the things that I like, if two people always agree, then one is unnecessary. So, even people like you and I who agree on lots of things, sometimes we'll disagree on things. But what that does in the world I grew up in, or we grew up in, is it encourages dialogue and debate in search of truth. And one of the things that drives me crazy today is if you know someone has a different view than yours, so often today, because of social media and the polarization, it's like, oh, you're dead to me. No. You should engage with those people and really embrace different views and alternative thinking. In fact, that's our byline is, I came out of the endowment world. I managed endowments in what I call my chapter one. So I came out of school, worked in the investment business. Then I went back to my alma mater at Notre Dame, and then eventually came down here in North Carolina, and I ran endowments. And so I was an allocator, and I gave money to the best and brightest around the world. And one of the things about being in that world is you tend to have a heavy allocation to this thing called alternative investments. I'm like, well, what is that? Right? There's four investments. There are stocks, there are bonds, there are currencies, and there are commodities. And yet everybody says, oh, but you guys do all these hedge funds. I'm like, right. That's a legal structure. They own stocks, they own bonds, they own currencies, and they own commodities. They can go long and they can go short, but they only own the same four things. Oh, well, you guys do all this private equity. Right. That's a common stock, a preferred stock, or a convertible bond. And so I really don't know why people get so, bent out of shape with this thing that it's alternative. Because I say, alternative to what? Hedge funds are just a legal structure. Private equity is a way of wrapping up common stock or preferred stock, convertible bonds. Venture capital, I own common stock, sometimes preferred stock. So we say alternative thinking as opposed to alternative assets. And so with all that, we've tried to take this view of alternative thinking and really inculcate it into what we do in what we call chapter two. So in 2004, I left the endowment world. I started Morgan Creek Capital Management. And for, this is our 20th year. We're literally next, or 2 weeks from now, going to celebrate our 20th anniversary, which is hard to believe. But for 15 of those years, we focused on this chapter two, which was taking a global view, a macroeconomic view, and then allocating to the best in class managers in these alternative areas. in hedge funds, in private investments, in real estate, in venture capital. And we helped investors integrate these alternative approaches into their portfolio. And in so doing, we always would come up with a global view, start from first principles and look around the world and say, okay, well, what do we like? Stocks, bonds, currencies, commodities. If we like equities, why do we like equities? Do we like them because they have high growth? Do we like them because they have good valuation? What about fixed income? Do we like the direction of rates? Do we like what's happening in the debt markets? What about commodities? Today, as we're sitting here today, I'm sure you've talked about this a lot with other guests. Hard assets, right? Precious metals, industrial metals, things are priced at the lowest level they have ever been relative to paper assets. Things like stock certificates and companies like NVIDIA. When you look at the deviation between the valuation of those two assets, it's never been wider. And that's a conundrum because I would say, right, in the kids game, rock, paper, scissors, paper beats rock. But in real life, over long periods of time, rock has definitely beat paper. Real assets, things that you can touch and feel. Take gold, for example. Gold for 5,000 years has been a perfect store of value. Now, what does that mean? It means that it has protected you against the ravages of a devaluing currency. Here's a stat that most people have no idea. Since 1996, US equities are dead flat, priced in gold. So they're at quote unquote all-time highs, NASDAQ and the S&P, priced in nominal dollars, but priced in gold, which is a store of value. They're dead flat. And why is that? It's because when we left the gold standard back in the 70s and we went on a fiat standard, we could create this inflation from thin air and devalue the thing that we all get that compensated in. And it creates this money illusion. Housing is a great example. You guys are up in Canada. I'm sure you struggle with this as much as I do. You look at what $1 million buys you in the real estate market in a Vancouver, in a Toronto, in a LA, and it's a ramshackle shack, right? I mean, if you want a nice home to live in, you're paying orders of magnitude more. And I joke, since 2000, right? According to Zillow down here in North Carolina, my house has almost doubled. Now, my house did not grow. It did not get more efficient. No new rooms popped up. In fact, I've had to put money into it to kind of keep it from deteriorating because it's about 20 years old now. So what happened is the house didn't get better. The money got worse. So from the beginning of our republic in 1776 to 2020. So from that, 244 years, we printed $10 trillion. And then the next 24 months, we printed another $10 trillion. So first 244 years, 10 trillion, next two, 10 trillion. So in theory, the value of the asset, the dollar should have depreciated by 50%, and the value of homes should have doubled. It's kind of exactly what happened. Gold prices doubled. And so stock prices, while they appear high, I will argue are a money illusion. So what does all that mean from a macro perspective today? It means today, every year we get together in January with our clients, and I blatantly stole this from another person that you and I have known for many, many decades now, Byron Wien. Byron does his 10 surprises, and you've done a version of it, and I blatantly copied his 10 surprises. But I can give him credit. I say I'm channeling Byron. And remember, a surprise is not a prediction. It's not like I'm saying I'm smarter than everybody and I know what's going to happen. Basically, what I do is I sit down in January and I go through all of the data on what is the consensus? What does everybody believe? Because if everybody believes it, you probably can't make much money betting on it, right? George Soros said it best. You make money betting on, things that haven't been discounted or perceived. And so we come up with the antithesis of the consensus and say, this is a surprise that if this were to happen, you could probably make money. And I'll give you a great example. So at the beginning of this year, you'll remember this. Well, actually, I'll ask you, Dave, how many interest rate cuts was the Fed going to make based on December, January estimates in the market? What did everybody think?
6.
Yeah, 6. And how many have they made? 0. How many are they likely to make? 0. So I will take the under. We're down to 1, and maybe it was 1.2 or 1.3, but we're basically down to 1. And my guess is there's going to be 0 because there's no basis to cut rates. And what did that mean? That meant that if you were betting on things that were helped by lower interest rates, you're probably going to be disappointed. Now, I say that with my hat in hand because so far that's been wrong. Because if you look at equities, which the play on equities coming into this year was they were going to have a good year because the Fed was going to cut. And even though earnings were bad after the collapse from 2 years ago, even though they hadn't recovered, and even though 42% of small cap stocks don't make any money, despite all that, it was going to be a good year for equities because the discount rate was going to fall and we could pay a higher multiple. Well, here's the funny thing. The discount rate didn't go down, but the multiple has gone up a full 5 points. We went from 22 times to 27 times. We are at the second highest multiple of earnings of the S&P that we've ever had. And that doesn't mean it's going to crash tomorrow, but it means that the risk reward of buying equities here. I'll give you a great example. So I'm sure your clients and you talk about NVIDIA all the time, like everybody else. So I got a text from a family member last week when they announced their 10-for-1 stock split. Hey, do you think I should buy NVIDIA? I'm like, that is the top. Now, it actually wasn't the top, but that's about as close to the top because they didn't text me a year ago or 3 years ago or 5 years ago saying, hey, what do you think about this company, NVIDIA? They're like, oh, I heard the stock is splitting 10-for-1. Shouldn't I buy it? Well, there's no information content in a stock split, literally. Now, historically, that has had a correlation with further price rises because they've normally been done when the price has gone up so much that the average person feels they can't own a share other than Berkshire Hathaway, which has never split their stock. So, but there's no information content in the number of shares outstanding. In fact, some would argue that it's a little bit of a Ponzi-nomics kind of scheme. So if we look around the world today, we are pretty bearish from this point on equity markets broadly. And if we break that down even further and we look at the 3 developed markets, we'll rank those. And then the 4th market we look at is the emerging markets, which is not really fair because emerging markets are not one homogeneous group. We have to break that down even further between like the super developed, like is Korea an emerging market or Taiwan? I will argue neither one of those is an emerging market, but they're both in the emerging market index because the people who run money in the index funds don't want to have to give back a third of their assets. So they lobby MSCI to keep those 2 countries, but Korea and Taiwan are not emerging markets. So arguably India and China, are they really emerging markets? Is Russia an emerging market? So you have to separate, I think, some of the emerging markets from the true emerging markets. Like, is Mexico an emerging market? I mean, compared to Colombia or El Salvador. So very different markets. But if you look at the big 3, we think the U.S. is by far and away the most overvalued. I can go chapter and verse on why we believe that. So we're most underweight the U.S. that probably as we've ever been. We were pretty underweight in 2000, 2001 when I was still at the university. In fact, we were probably even almost net short. We had a lot of hedge fund exposure back then. Today, we're not quite there, but we're getting closer. Next, we like Japan, but Japan's had a really good run. We like Japan because Japan has a unidirectional trade, which is weaken the yen, therefore stocks go up. And that trade is going to go for a very long time because their debt to GDP ratio is really bad. So we still do like Japan. There's a lot of cheap stocks in Japan. And so that's a market we like better than the US. And then finally, Europe of the big three, we think is the best. Ms. Lagarde just cut interest rates, again, probably ill-advisedly, but she's more politician than economist. So, we think there's some pretty good opportunity in Europe, and the prices are orders of magnitude cheaper than the rest of the world. Emerging markets, again, we like China a lot. Most people hate China. Most people think China is uninvestable. Gina Raimondo is out telling people that China is uninvestable as Secretary of Commerce. I'm like, that seems like a really bad thing for the Secretary of Commerce to be saying, but okay. And look, the Cold War between the US and China has been brutal. There was a near perfect correlation between the US and China from 2000 to 2020. And in 2021, they diverged. In fact, most people would not believe me if I told you that from 2000 to 2020, Chinese stocks outperformed US stocks. No, they didn't. Well, they did. And in fact, from 2020 to today, Indian stocks have almost doubled US stocks. That's not possible. Well, it is. India's been the best foreign market by far, emerging market. So Chinese equities, super cheap. Take a company like Alibaba. Alibaba today sells at the same price as IPO 5 years ago. They've increased their revenues 10 times. Their price earnings ratio is lower than the NASDAQ price to book ratio. Just let that sink in for a second. So that seems like, another example, back to Europe, right? Deutsche Bank is way cheaper than JP Morgan. Not that JP Morgan's bad, but if I had just to do a basis trade, I would be long Deutsche Bank and short JP Morgan. I would take my interest rate risk out by being net neutral to interest rates, and I would just take advantage of the valuation discrepancy. Everybody says, oh, but Deutsche Bank is over-levered. It's a terrible bank. True, but Germany's never going to let it fail. So it's too big to fail. It'll outperform JP Morgan, I would think. So we look at it that way. When we think about interest rates and bonds, let's go from equities to bonds. In the bond market, we would say that bonds are super oversold. Right? They've had their worst 3-year run in the history of the bond market. That's 240 something years. It's pretty bad. But the problem is a supply and demand problem. The supply of US bonds, and it's the US market I'm talking about, US bonds, the supply is too big, right? We have to refinance over $1 trillion of debt this year in the next 12 months, because instead of locking in 30-year and 40-year and 50-year paper back when interest rates were zero, Ms. Yellen was refinancing for 1 year. Idiotic. I mean, one of the dumbest treasury moves in history, and yet, she was elected like Time Person of the Year. Ridiculous. One of the worst performances of a treasury secretary in history. But that's what happened. And so here's where we are. Our interest costs are now hitting over 20% of the budget, which they've never hit before, over $1 trillion. And so the refinancing costs of the crazy spending in Washington are causing a supply-demand problem. Japan isn't buying our debt. China's not buying our debt. They're actually divesting. Russia's not buying our debt. Saudi just made a huge decision. I mean, this is a monster decision. We'll be talking about this decision in the next 20 years, like we talked about the original decision in 1971, when Saudi and the US cut a deal that Saudi would price all oil transactions globally in dollars. And we would protect them at any cost. No matter what they did, no matter who they, beat up or got rid of, we would protect them. That's now off the table. They did not renew that 50-year deal, and they are more aligning with the BRIC countries, and that has huge implications for the petrodollar, has huge implications for the dollar generally, and we think it has huge implications for things like gold and Bitcoin. So bonds, as much as they should go down in terms of interest rates, should be falling because we're in a deflationary world rather than an inflationary world. Everyone's talking about, oh, this is like the 70s. I just did a webinar about this last week. This is not the 70s. The 70s was demand pull inflation. We had the boomers, people like you and me, who were aging into the most productive years of their lives, forming families, buying houses, buying cars, taking vacations, and we had massive growth in the 25 years following the 70s. That is not what we have now. We have 10,000 people every single day turn 65 in this country, and 65 to 85-year-old people, they don't spend a lot. They're not very productive. They're perfectly nice people, but they are not a growth engine. And there's a perfect, and I do mean perfect, correlation between working age population growth and GDP. I mean, it's perfect. And so our working age population growth is going to be sub 1% for the next 20 years. Our productivity is going to be sub 1% for the next 20 years. That means we're going to have sub 2% growth for a very long time. So this idea that we're somehow going to get demand pull inflation, what we have is currency devaluation. We printed so much money in 2020, 2022 because the cult of Kelton, all these people in Washington believed this idiot, Stephanie Kelton. I shouldn't call her an idiot, but she is an idiot. I mean, how she calls herself an economist, I don't know. But maybe the dumbest thing we've ever done as a country was to print that much capital. Now, they tried to pull some of it back over the last 2 years. We had the first negative money supply growth in over 100 years. And that's why the market crashed 2 years ago. And that's why things were a little dicey. They've reversed that, and we've gone back to printing money in DC. And I think that's bad for the currency. Again, good for hard assets, good for gold, good for Bitcoin. So third asset is commodities, hard assets. We like hard assets of all kinds. Copper. I mean, the copper demand supply problem, it's epic. It takes 400 pounds of copper to make an EV. And there are a lot of EVs, not just here in the US, but in China. China's selling way more EVs than we are, and they are amazing. And they are electrifying their grid super fast. They're producing clean energy with nuclear. I mean, it's a great story. Copper prices are likely to go higher for a long time. Other, rare earth minerals, super demand supply problems, things like cobalt and manganese and lithium and others. So those all look pretty good to us. And we think the big three currencies are in a race to the bottom. The dollar, the yen, and the euro will be longer for the rest of our lives. And what does that mean? It means the Renminbi will go up. It means Bitcoin will go up. It means gold will go up. And it's not because those things get better. This is a really important point. A single ounce of gold stays a single ounce of gold. A single ounce of gold has been a single ounce of gold for 5,000 years. It has never changed. But if you exchanged a single ounce of gold with another person for the last 5,000 years, you would get a fine person suit, from Cleopatra's time to a suit of armor to a zoot suit in the 20s to Savile Row today. A single ounce gets you a fine person suit. Why? Because paper currencies come and go, they inflate away, they devalue. 775 paper currencies in the history of mankind, 3/4 of them no longer exist. The oldest, the pound sterling, 338 years, used to 1 pound note got you 1 pound of sterling silver. Now it takes you 174 pounds of sterling silver equivalent. So they devalue the currencies by removing them from the gold standard or the silver standard. And now, because they can be created out of thin air by fiat, what happens is the things you can't print, gold, houses, metals, okay, gold bars, silver ingots, or Bitcoin, they go up, but they don't go up. 1 Bitcoin is 1 Bitcoin. 1 ounce of gold is 1 ounce of gold, but we don't price gold in gold. We price gold in dollars or yen or euro or Italian, or Turkish lira or Argentinian pesos. And in those currencies, gold prices are setting all-time highs. In yen, gold prices are all-time highs. In yen, Bitcoin's all-time high. Maybe it's not an all-time high in dollars because the dollar is a little less bad than the yen or the euro, but eventually it will be at a new all-time high when it's priced in dollars. So commodities we tend to like a lot, and then currencies. I said currencies for us. You've got the big three that are in a race to the bottom. You have the Renminbi, which we believe wants to be the global reserve currency. The history of global reserve currency is very interesting. So for years, it was gold, and that's all you could trade. But the problem is carrying around sacks of gold was very hard. So these knights, these monks in Portugal, created a banking system and said, leave your gold with us, go out on your crusade, and when you come back, we'll pay you interest and we'll make you whole. Problem is, a lot of those people never came back. And so they end up with all this gold. And so they started lending it out, and they created fractional reserve banking. The Medicis borrowed that idea in the 1200s. And so Venice and Rome became the center of the universe for about 200 years. Then the Portuguese created the fastest navy and created the most powerful superpower in the world. Think about that. Little tiny Portugal, about the size of Ohio, was the superpower of the world in the 1400s for about 80 years. Then Spain took them over. And then, interestingly, the Netherlands, also about the size of Ohio, took over Spain. And you think, how the hell did they do that? Well, they invented the first central bank. So the Dutch created a bank that would create money not from reserves based on gold, but based on decree, based on fiat. And so these wealthy families could make money out of thin air, and they created a mercenary army that conquered the Spanish Armada, and they became the superpower. And so they infiltrated, they bought New York and all this stuff, and, because it was called New Amsterdam, and the Dutch Empire was born. And then they let their guard down, and the French took over. We've all seen the movie with Napoleon. And then the British, one of the families from the Netherlands, took the idea for the central bank and took it to England and created the Bank of England, who then financed the first steamships, and they had the most powerful navy, and they took over. Then this little colony over here in the United States created the central bank in 1913 in cahoots with the Bank of England through this guy named Junius Morgan, JP Morgan's dad, and the Fed was created. So it's interesting. From 1776 to 1913, Dave, a dollar was worth a dollar. From 1913 to today, a dollar is worth about 2.5 cents because of this thing called inflation, which is a stealth wealth tax. So that is our worldview. How does it go to what I do on a day-to-day basis? So 20 years ago, I spent all my time traveling around the world, talking to the smartest people in the world and trying to decide if I want to give them money. And it was the greatest job in the world, right? I got paid to talk to Paul Tudor Jones and Julian Robertson and George Soros and, Hugh Sloan and all these amazing managers all over the world and allocate capital to them. And that was a very profitable business. And throughout all of that, one of the areas that I had always focused on was venture capital. Why? Well, part of it is my life story. I grew up in a house where my dad sold and installed mainframe computers in the 60s. Now, why did he do that? Well, the mainframe was invented in 1954, and Digital Equipment Corp and IBM and Unisys and Burroughs, they had these big giant computers that governments would enable you to own at the corporate level. And so my dad helped, install those computers. So I grew up the son of an android who installed those for Arthur Andersen. And then in 1968, there was this big innovation down in Silicon Valley to make microcomputers. Well, now small businesses could have computers. Then in 1982, where I grew up in Seattle, there was an innovation around personal computers. And it's funny, Steve Ballmer's mom famously quipped, "Honey, why would you work for that company? No one would want a computer in their house." And she was quoting the Digital Equipment Corp CEO, who had said in 1979, no one would ever want a computer in their house. Steve has 18 billion reasons he was right, mom was wrong. And the guy was wrong too. In fact, he ended up selling DEC to a personal computer company, Compaq, in 1996, which is kind of funny. So 14 years later, there's an innovation around this thing called the internet. And I was sitting up at Notre Dame, and we had made a bunch of investments with a bunch of venture capital companies, Sequoia and Kleiner Perkins Caulfield Byers and Mayfield and Accel. And long story short, we gave some money to Sequoia back before they were famous. And they gave some money to this little company called Google. And I still remember, Dave, going to our board and explaining how we had made this investment in Google. And they're like, that's a stupid name. Now it's a verb, right? We probably said it 10 times today. But at the time, it was kind of a stupid name. And they're like, why would you invest in the number 21 search engine, right? There's Alta Vista, there's Web Crawler, there's Ask Jeeves. Why do we need another search engine? Well, what they didn't understand, I didn't understand either. They didn't understand it wasn't a search engine. It was a different way of processing information. They don't search the internet. Google owns 1/2 of all the websites in the world. Over 1.7 billion websites in the world. Google owns 1/2 of them. And what each website does is it has all the information related to a specific question. So when I type in a question, it sends me to that website because they've already answered that question. Now, if I ask a new question, which is rare, they have to build a new website. But most questions have already been asked, so they know where to send you. That's called indexing. And our $5 million that we gave them turned into 200 million. Like, that's pretty good. So ding, 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 light bulb goes off. This is good. Invest in infrastructure around technological innovation. So in 2010, the internet comes up and we invested in a bunch of companies like Facebook, which everyone said was stupid and they'll never make money. Yeah, they make a lot of money. We invested in Alibaba, so they never make money. They make a lot of money. And so we made even more money in Web 2. And 14 years later, now it's always 14 years. Here's the interesting thing. Every technological cycle, 1954, 68, 82, 96, 2010, 2024, which we're in right now, Web 3, every 14 years, there's an innovation around computing power. And we get an exponential, not a linear, we get an exponential lift in computing power and an exponential growth in total value. So Web 1 created $2 trillion of value, right? NVIDIA, in part of Web 3, created 1 trillion in the last 6 months. 2 trillion in all of Web 1, okay? 1 trillion just from one company as part of Web 3, okay? Related to AI. Web 2 created 5 trillion of value, more than 2. Web 3, we think will create 15 to 20 trillion. And so 5-6 years ago, I started shifting most of my time to the digital asset ecosystem. So now I am a late in life venture capitalist. It's my chapter 3. Chapter 1, not-for-profits. Chapter 2, Morgan Creek Capital Management. Chapter 3, Morgan Creek Digital. And now we're raising our 4th venture capital fund, one in 18, one in 20, one in 22. And we invest in companies that are building out the digital asset ecosystem. And the reason is blockchain technology is as foundational to computing, right? The future of computing as client server was in the 1990s, as the internet was in 2010, as we went into a Web 2 world. And so we're going into this Web 3 world. And the best way to think about it, Dave, is there's a great book and everyone should read it. All your guests should read it. Clients should read it. It's called Read, Write, Own by Chris Dixon. And what it means is Web 1 was about reading information on the internet, right? You couldn't interact with it. You could just read it. And instead of going to, remember the Encyclopedia Britannica that we grew up with, right? The physical 26-volume book, right? And they would, bring it to your house and you'd have it and you'd look it up. By the time you were reading it, the information was stale. It was terribly biased. It wasn't very useful, but that's what we had because you couldn't get information. Then Wikipedia came and it popularized group sourcing information. So we had better information at our fingertips, but all you could do is read it. And the companies that won in that world were the infrastructure providers, the picks and shovels, right? The networks and the switches and the computer, the screens. Well, in Web 2, we had an innovation around read, write. So now we could download information. Now, here's the genius part. So we would post pictures on our Facebook accounts. We didn't get paid for that, or we would make videos for YouTube. So we would spend all this time, human talent, create content, give it to the tech company, who then sells advertising space and makes billions and billions of dollars. Good for them. And we got a service, right? We got entertained by YouTube, or we got entertained by Facebook and social media, but we didn't win. Well, now in Web3, it's read, write, own. So what blockchains allow us to do is own our content. Like when you're scrolling on the internet and you have a cookie, you don't own that information. The tech company owns that information and they can sell it. In a Web3 world, I'm going to have an NFT, a non-fungible token, which is just an entry on a ledger, and it'll have all my activity. And I can decide if I want to sell that to Best Buy, if I want to sell that to Walmart, if I want to let somebody see what my browsing history looks like. And that ability to own content will revolutionize the creation of content, because the person creating the content now gets rewarded. And it's a really amazing, transition in the world. And I don't want to be too hyperbolic about it, but it's why everything in the four areas, I say, everything's in fours, right? We have A, T, C, and G, the four elements of DNA, and they make up all life and every combination thereof. And then we have the four assets: stocks, bonds, currencies, commodities. We also have four elements of the digital age: A, B, C, and D. AI, blockchain, chips, and data. And the way it works is data is the new oil. The most important, most valuable asset in the world is data. Data that we produce, data that we consume, data that we give away for free, and now that we're going to own. But the data, like where we look, where we click, where we interact, where we buy things, how much we have, what we can produce, all that is data. Well, data has to be organized, captured, stored. That's what blockchains do. They're simply a better way of capturing and organizing and storing data. They're more secure, they're more permanent, they're more immutable, they are decentralized instead of centralized, so we can own that data. But there's a better way of organizing data. Chips and computing platforms are simply ways to analyze data. So everything that we do, right? You and I are using chips right now to communicate, voice over internet protocol. But here's the funny thing. Tim Berners-Lee invented the internet, right? Not Al Gore. Al Gore did save the internet, actually, because Verizon and AT&T were trying to kill it because they didn't want us to use voice over IP. They wanted to charge us $3 a minute to do what we're doing now. But so Al did cast the vote to kill the bill, but Tim Berners-Lee invented the internet. He took this protocol that Vint Cerf created, TCP/IP. Well, he created the TCP part on top of IP. And Tim wrote the first web page, first HTTP, before they added the S. And that was the creation of the internet. But he didn't get rich because he couldn't own what you and I are using right now, right? He couldn't own TCP/IP. He couldn't own HTTPS. He couldn't own voice over internet protocol. So he didn't get rich. Who got rich? Zuck steals an idea from the Winklevoss twins, creates a platform where people could post their content. He takes that data and sells it and monetizes it. And it's a great business. Okay. But the application layer, not the protocol layer, made all the money. In Web3, all the value is going to the protocols: Bitcoin, Ethereum, Solana, Avalanche. The protocols themselves can now be owned in this Web3 world. And it's one of the great evolutions of both computing and investing. So chips enable that, right? They create better processing, faster processing, and we see that in specific AI chips and chips to do games and all the things that okay, if someone says it rots your brain, you should probably invest in it with both hands, right? When they say video games rot your brain, you should probably buy it. But NVIDIA is a pretty good company. So, but the last part of it is AI. AI is simply a tool. It's nothing more. It's a tool that allows you to make decisions with data. And what's really interesting is there's all this hype about ChatGPT and LLMs, large language models. Well, let's think about this. What are they really good at? They're really, really good at plagiarism. They basically put plagiarism out of business because they can plagiarize better than any of us can humans, because they can search all information and plagiarize it perfectly and feed it back to us. They can't create new thought. They can't create new ideas. They can't create intuition. They're not really intelligent. They're amazingly good at plagiarism, way better than we could ever be. But that's no different than a hydraulic lift is way better than you or I at lifting up big boulders or putting girders on buildings. So each tool that we invent to solve a problem makes us more efficient. And what AI tools do, which I always laugh, AI is an 80-year overnight success story. The term was coined 80 years ago. I'm old enough to remember 1980 was the Time Magazine Year of AI. Cover story, little rocket ship, Year of AI. In 2000, 20 years later, Intel stock went up 20-fold in 12 months because their chip was going to revolutionize AI. Today, their stock's 40% of that high, 24 years later. So things change. But AI is a tool, and LLMs are a good tool, but there are lots of tools that will be created using these AI tools that will help us do things better. And yes, some white collar jobs will go away, no different than a bunch of physical labor jobs went away when the industrial age came, no different than when street sweepers went away, when the horseless carriages went away. But here's the thing. Everyone's worried that AI is going to kill all these jobs. Yep. Tech has always killed jobs. But here's a funny thing. It's killed millions and millions and millions and millions and millions and millions of jobs, right? But we have more jobs on planet Earth today than any time in human history. Full stop. Amazon, which didn't exist 27 years ago, employs almost 5 million people. Company didn't exist. Now it employs 5 million people. So we will find ways to utilize this technology to create more jobs, more opportunity, more, because what each one of these innovations does is it unleashes the most powerful force in human history, which is human creativity. So it's why it's my pinned tweet on Twitter, right? The greatest fortunes come from investing in innovation. To invest in innovation, you have to invest in something you believe in before others even understand. You'll be mocked and ridiculed and chastised for your non-consensus actions. It's totally worth it. And so at the very beginning, when we did an introduction, right, we talked about this. Independent thinking. Not thinking different to think different, not being a contrarian to be a contrarian, but thinking independently and not listening to the masses and saying, what could everyone else be missing? What's possible? Right? The best investors are people who can imagine the unimaginable. I stole that from John Burbank. But anyway, so that's my world view, and happy to answer questions or riff on anything you want.
A lot of questions have come in, so we'll get to them. You said NVIDIA is a good company.
Yeah.
Is it a good stock?
No. Nope. And look, I've been wrong early. Early is just the euphemism for wrong on this for a while. To be fair, when it hit $400, I said I would take profits, and I'm wrong, right? But here's the thing. It is a very good company, but no company, and I believe this strongly, can justify a price to sales ratio above 10. No company has ever survived a price to sales ratio above 10 for very long. You can do it for a very short period of time. This company sells at 36 times sales. It's not sustainable. And it doesn't mean it can't. See, the problem we have, Dave, and this is where old guys, one thing we really suffer from is we're trained under a set of conditions. And then as we practice for longer and longer, that set of conditions becomes not really relevant. So when you and I were growing up in the business, there wasn't a predominance of assets that was managed passively, right? It was mostly active management. And why is active management different than passive? Well, active management is allowed to think. Passive management is dumb. And I don't mean unintelligent. I mean, it's unthinking. A capitalization weighted index, every day that NVIDIA stock goes up, the index must buy more. It can't say, well, does that make sense? Is that logical? And so the only time we saw anything similar to this was in 2000, the first time we had the parabolic moves. And for the first time, we had not a majority, because today we have a majority, but we had for the first time more than 20% of passive strategies. But the key was the bulk of the new money in the last part of 1999. What happened was the Fed, because they were afraid of Y2K, pumped $500 billion into the economy. Back when $500 billion was a lot of money. That had never been done before. And that $500 billion went in to a very small number of stocks because of capitalization weighting. So everybody bought these indices. Intel went up 20 times, Cisco went up, and Cisco was selling at 286 times earnings. $1 of earnings, you had to pay $286. And I actually said, I think it's going to go to $5. And it almost got there. It got to 7. And I said it would never, ever, 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 ever get back to that all-time high. Still not back. I still stand by it. It'll never get back there. Same with Intel. And the reason is there's no growth rate you can grow at to turn $1 into 286. You just can't do it. So that happened. Well, this time it's happened again, but it's worse because now 51, 52% of money is in these passive strategies that aren't allowed to think. And what's worse is, again, when we were growing up in the business, there were people like Jim Chanos and other short sellers, Julian Robertson, Michael Steinhardt, George Soros, who would say, that dude's not wearing any clothes. The emperor has no clothes, right? I'm going to be short that. I'm going to short that asset. I'm going to short that stock because it doesn't make any sense. And again, I remember it like it was yesterday, March 19th, 2020, Julian sent out his letter saying, I don't understand anymore. I'm shutting down my fund. Now, here's the funny thing. We were one of his largest investors back then. We kept our position. We did not sell. In 2020, Julian was up 54%. Now, he was down a lot through March, but by the end of the year, he was up 54% because the world changed and value came back in vogue. Now, I'm not saying that's going to happen tomorrow, but I do believe it's a long answer to your question. Is NVIDIA a good stock? No, not here.
You mentioned that data is the new oil.
Yep.
So let's talk about oil. In fact, I noticed you didn't mention oil when you mentioned all the other.
Thank you.
The question is,
I should have.
I mean, if you're bullish on commodities, you have to be bullish on oil. The
I
question
am except oil is the most political asset in the world. Full stop. More political than anything else. Why? There's a perfect inverse correlation between presidential popularity and gasoline prices. So before every single election in the history of elections, you will find some sort of activity to pushed the price of gasoline lower. At the midterm election, it was Biden selling down the Strategic Petroleum Reserve, right? He tried to get MBS to pump more oil. MBS said, take a hike. That was when we knew that, tensions had gone negative with Saudi. And so he said, fine, I'll just sell the SPR. And he got oil prices under $3 and Democrats did fine. So oil should be going up. We have increasing demand. China's recovering. India's growing like a weed, probably 7% this year. Fossil fuel use around the world is higher than it's ever been. We'll use more than 103 million barrels of oil this year. Oil price should be higher, but the U.S. is pumping more oil than we ever could have imagined. And look, I remember saying this 15 years ago, like it was yesterday, that there was a reservoir under Texas and Colorado the size of Saudi Arabia in the shale. The problem was, at the time, the technology to get it was you had to drill a mile down, stuff a tungsten steel rod, heat it to 700 degrees, and that just sounded really expensive to me. So I didn't think that was going to work. Well, they found a better way. They didn't use the tungsten steel rod and heat. They fired down, pellets of sand and cracked the shale, and the hydrocarbons released. So, we set new all-time records. We're the largest oil producer in the world. Now, that should have led to reasonable heads prevailing, and Saudi should have cut their production because they need higher oil prices than we do to balance their budget because they're a unidimensional economy. But they didn't. I mean, they cut a little, but they didn't cut enough. So we have a supply problem today, and oil prices are falling. And look, I think pre-election they fall further because that's what the president needs to try to get reelected. So other than that, I think oil price should be higher. The supply demand story is really positive. I love oil stocks. I mean, love them. And I own a lot. I own the MLPs. I own a lot of them because they don't really care about the price of oil. They just transport hydrocarbons. So, but I think most people have given up on hydrocarbons, but the quality of life in the world is better with hydrocarbons than without them. So I'm a big fan.
Okay. Something else to discuss. You'd mentioned that European equities in the public equity space is still on your buy list or your.
Yep.
But are you changing your views at the margin based on the politics there? We're about to have a Labour government take over in the UK. We just had this really nasty vote against Macron, and we have either the possibility of far right or a left-wing coalition. Either way,
look, I bring the far right, baby. I mean, far right.
But either the far right, the problem with the far right and the far left is none of them have any fiscal rectitude in their agendas at a time when France just got downgraded, right, by S&P.
Sure.
So being on the far right, they're anti-EU, but they're also big deficit people, and the people on the left. The only people that might not be, although I guess Macron is in the center, and we're running over a 5% deficit GDP.
Yeah.
France.
I'm
not trying to get into a debate. I'm just trying to say, are you factoring political risk in Europe?
I hear you loud and clear, but to me, it's the same in all of the big three: U.S., Europe, and Japan. We're not going to solve our deficit problems. I actually don't believe in the left and right anymore. I believe there's in and out. And when you're in, you do or say whatever it takes to stay in. And when you're out, you do or say whatever it takes to get in. So I think they're all big spenders because that's how you get elected. And that's how you enrich yourself once you are elected. I mean, it's unbelievable. It's unbelievable that in the US, we have a Democratic majority and we have the largest deficit in history. And we've taken $200 billion and money laundered it into companies that the congressmen and senators can own and trade before, they make the allocations. When McConnell said, "Hey, that money's not going to Ukraine; it's coming right back to the United States into companies we all own." I'm like, wow, he actually said the crazy part out loud. But Europe has the same risk. Japan has the same risk, but they all have the same solution. The central bank's going to buy all the bonds. Eventually, they're going to do a debt jubilee. Japan will be first, US will be second, Europe will be last. And Ms. Lagarde is a bond buyer of last resort, almost as good as my favorite.
But the question I would have, Mark, is between now and the time that the ECB would be the Hoover vacuum, you could have said that the pigs, Portugal, Italy, Greece, are going to get bailed out. But there was a 2-year period of intense pain if you were long the euro and long European stocks.
For sure.
So the question my only question was, if you're saying I don't invest around politics, I'm putting that aside, because it seems as though certainly the markets last week told you that there's some re-rating going on, and we don't even know yet after July 7th who's going to be running France, right?
No, I think it's a really great insight. I do. I guess I think, and it's just one person's opinion, I think there's enough cushion in valuations in Europe that you can stand the volatility a little better. And it's just because you're not paying as big a premium as you are in the US or other places. So it's not as cheap as Japan, but it's relatively cheap. And there are some really, really good businesses in Europe, some of these kind of serial acquirers and compounders that they do a good job. So I don't disagree with you at all that short-term pain is probably real, but I'm underweight equities broadly. I'm super overweight private, very, very overweight venture capital. I think this vintage year for venture capital will be one of the best in the last 40 years because of all the dislocations in tech and how everybody's afraid. And so they're not investing as much. So, but if you forced me to invest in equities, I'd own a little bit of Europe, a little bit of Japan, a little bit of emerging markets, not much US.
Right. Now, and I just want to be clear on your bond call. You sound like, even though you're more in the deflation camp than the inflation camp, you think that there's too much supply. So it sounded to me like you weren't bearish, but you weren't bullish on the treasury market.
No, that's exactly right. I want to be bullish because everything in my brain, everything in my analytical framework, not my brain, but in the analytical framework of saying too many people retiring, too many entitlements, too much deflationary technology, all this amazing technology is incredibly deflationary. All of that is good for interest rates going down. But the idiocy of fiscal management and the inability to stop pork barrel spending says to me that it's a wash. So I'm not like, oh my God, you got to be short, but I can't back up the truck because the fiscal lunacy.
So speaking of fiscal lunacy, and this will be the last question we'll wrap up, is November 5th.
Ha! Yeah.
So what do you like? What would you respond differently? Leave Congress aside, but
yeah,
Biden versus Trump, what leaves you investing differently with one or the other in the White House?
Yeah, look, I think a Trump victory, just like last time, super pro business, super pro Bitcoin, because he's kind of using that as one of his campaign platforms because the Democrats are too stupid to jump on it. But I think super pro business, he's threatening tax cuts. I think both are, look, it's very popular to bash China. So I was hopeful that he would see the light that tariffs are a bad idea, but he's doubling down on tariffs. So I think the Cold War will continue.
Mhm.
Look, the China thing it's real, right? They are producing more scientific breakthroughs than we are. The reason we hate Huawei is because they're kicking our ass. They used to steal all our tech. Now they produce better tech than we do. It doesn't mean we don't produce good tech. We do, but they're really really good at tech now, and they caught up. So, um, but I I'm very afraid, honestly, of 4 more years of what we got. I think this is maybe the most horrific administration, certainly in my lifetime. I won't say it's the worst in history, but certainly in my lifetime, it's not close. I mean, really, really bad policy on on every level. Um, and I think it's like really ugly. Like like at least with Trump, and when he was in the first time, I knew everything he did was just to enrich himself and his family, and I could invest around that. With the current people, I just don't know who to be afraid of. I just don't know who's running the show, and it just seems so many incongruent policies, and just everything they do seems bad. So I would like, as much as I dislike uh, Trump as a human, um, I think he's marginally more competent, which is frightening. Um, and I do think he did surround himself with better quality people. I think the appointees in the current administration have been pretty darn weak, like extremely weak. I thought the Trump appointees were at least good business leaders, good thinkers. They didn't stick around long enough, but they at least were good people. So
Okay. Well, we're going to leave it there. It's the top of the hour. Thanks a ton, Mark, for your time, your great insights. There is a ton there for all of us to unpack. But thanks for drilling down to the asset mix level and going even beyond that.
no, well, thank you. It's always fun to do this, and it was a fast hour. If there are other questions, don't hesitate to shoot them to me. And if people have individual questions, literally DM me on Twitter. Just I'm at Mark Yusko. Send me a DM, and I'll answer your question because I enjoy the dialogue and debate in search of truth.
I think I'm going to get a lot of emails about how they can invest in you. So
Well, that would be fine too, and we're always happy to do that. We do have a lot of stuff going on in the digital asset ecosystem that I think everyone needs some exposure to. So happy to help.
well, I might have to get you back for another hour just on that topic alone.
No, let's do it. That'd be fun.
Well, that was great. Thanks again, my friend. A reminder to everyone that the next webcast is 10 days from now, June 27th. The usual 4 p.m. time slot when I'll be hosting the Dean of High Yield Bond Research, Marty Fritzen. This will be key since risk assets in general are typically priced off the credit market. High yield is always and everywhere the proverbial canary in the coal mine, so not a webcast you'll want to miss from the world's leading expert on corporate bonds and non-investment grade in particular. So that concludes today's webcast. Thanks again, Mark, for your participation
Thanks, Jay.
and to all the viewers for attending. Take care.
Really appreciate it. Take care.
You too.